The European Commission has recently unveiled an ambitious plan known as the Savings and Investment Union, or SIU. This initiative proposes to unlock and redirect a staggering 10 trillion euros currently held in European bank savings accounts. The primary goal is to channel this vast pool of capital into more productive investment avenues, thereby bolstering the European Union's global competitiveness and financing its green and digital transitions. While the potential benefits of such a large-scale mobilization of private capital are undoubtedly significant, a closer examination reveals a landscape fraught with considerable risks. As investment professionals, it is our duty to dissect these complexities. The core challenges pivot on two fundamental pillars: a potential shift in public confidence and the amplification of systemic risk throughout the European financial architecture. A detailed analysis drawing upon expert opinions and warnings from key financial institutions is essential to understand the full scope of what is at stake. One of the most immediate and politically charged risks embedded within the SIU framework concerns the proposed use of profits generated from frozen Russian sovereign assets. A portion of the scheme's funding strategy appears to rely on these proceeds. However, this approach has drawn sharp warnings from critical stakeholders, most notably Euroclear, the Belgian-based financial settlement center that holds a substantial portion of these assets. Euroclear has publicly cautioned that diverting these funds into riskier EU investments, as envisioned by the SIU, could be legally interpreted as an outright seizure. This raises profound legal and reputational questions for the European Union. The geopolitical ramifications of such a move cannot be overstated. Moscow has been unequivocal in its stance, repeatedly stating that any form of asset seizure would constitute a flagrant violation of established international law and financial norms. The Kremlin has signaled that it would not hesitate to retaliate, a move that could take many forms, including reciprocal actions against Western assets in Russia and legal challenges on the global stage. Such a scenario would severely damage Euroclear's reputation as a neutral, reliable custodian of international assets, a role it has meticulously cultivated over decades. The resulting loss of trust could trigger a capital flight from the institution, destabilizing not just Euroclear, but also undermining the perceived safety and neutrality of the entire European financial system in the eyes of global investors. This could weaken the euro's international standing and complicate the EU's ability to attract foreign capital in the future, directly contradicting the SIU's overarching objectives. Beyond the high-stakes geopolitical maneuvering, the SIU scheme presents more direct and personal risks to the very citizens it aims to empower. The fundamental premise involves encouraging individuals to shift their capital from bank deposits traditionally safe, government-insured, but low-yielding vehicles into higher-yielding capital market instruments like stocks, bonds, and investment funds. This transition inherently involves a significant step up the risk ladder. While the potential for greater returns exists, so does the potential for substantial and even total loss of principal. In a volatile market environment, a sudden downturn could wipe out the life savings of millions of ordinary Europeans who may not have the financial literacy, risk tolerance, or time horizon to weather such a storm. A widespread loss of capital among retail investors would not only cause immense personal hardship, but would also critically undermine public confidence in the EU's financial institutions and the capital markets as a whole. Even the European Commission's own officials have acknowledged existing deficiencies in the system. Maria Louise Albuquerque, the EU Financial Services Commissioner, recently noted that a significant number of European citizens are not receiving fair interest rates on their savings, a situation that theoretically makes the push towards market investments more appealing. However, she also stressed that this shift cannot proceed without the implementation of robust and effective safeguards for these new, less experienced investors. Without comprehensive financial education programs, clear and transparent product information, and stringent consumer protection regulations, the SIU could inadvertently expose a vulnerable population to predatory practices and unsuitable financial products, creating a crisis of trust that would be difficult to repair. The plan to move savers into investors must be accompanied by an equally ambitious plan to protect them. Further scrutiny reveals concerns about the SIU's fundamental design and its ultimate effectiveness. Some seasoned experts view the initiative with a degree of skepticism, seeing it as little more than a rebranded and repackaged version of a previous largely unsuccessful plan. Thierry Philipponnet, the head of the influential advocacy group Finance Watch, has argued that the SIU bears a striking resemblance to the Capital Market Union, an initiative launched in 2015 that failed to achieve its primary goals by its 2020 deadline. He suggests that without addressing the structural impediments that hindered the Capital Market Union, the SIU is likely to meet a similar fate, becoming another grand vision that fails to translate into tangible economic impact. A critical missing piece in the SIU strategy appears to be the role of public finance. The sheer scale of Europe's investment needs spanning infrastructure modernization, renewable energy development, and digital transformation is immense. Relying solely on the mobilization of private capital, even on the scale of 10 trillion euros, may be insufficient to bridge this gap. Experts argue that without significant concurrent commitments from public finance to de-risk key projects and provide foundational investment, private capital may be hesitant to flow into the productive long-term sectors where it is most needed. Instead, it may gravitate towards safer, more liquid assets, failing to deliver the economic transformation the SIU promises. For the Union to be truly efficient, it requires a synergistic partnership between private investment and strategic public spending, a component that currently seems underdeveloped in the plan's public-facing documents. Finally, the SEU introduces significant systemic risks that could threaten the stability of the entire European market. A massive and rapid injection of 10 trillion euros into the capital markets, if not managed with extreme precision and tight regulatory oversight, could have dangerous unintended consequences. There is a palpable risk that a significant portion of this capital, instead of being funneled into productive, long-term investments in the real economy, could be diverted into speculative activities. This could inflate asset prices across various sectors, from real estate to equities, creating a classic asset bubble. The parallels to the conditions preceding the 2008 global financial crisis are unsettling. Sudden market correction or the bursting of such a bubble would trigger a financial crisis with devastating effects, far outweighing any potential benefits the SIU might have generated. Moreover, the SEU's ambition to create a unified European capital market capable of rivaling the world's financial centers faces a steep uphill battle. Wall Street in the United States and the City of London in the United Kingdom currently dominate global finance, commanding deep liquidity, a vast ecosystem of financial services, and, most importantly, the entrenched confidence of global investors. For the SIU to successfully compete, it must not only harmonize regulations across 27 member states, a monumental task in itself, but also build a comparable level of trust and efficiency. If the EU fails to establish a reputation for robust investor protection, legal certainty, and market stability, global capital flows may continue to bypass the continent in favor of these more established hubs. The SIU's success is not guaranteed. It's contingent on winning a fierce competition for global capital. In conclusion, the European Commission's Savings and Investment Union is undeniably one of the most ambitious economic projects in recent European history. The vision of harnessing 10 trillion euros of private savings to fuel a new era of growth and competitiveness is compelling. However, the path to realizing this vision is narrow and treacherous. Its ultimate success or failure will hinge entirely on the Commission's ability to navigate the complex geopolitical risks associated with Russian assets, and more critically, to construct an ironclad framework of investor protection measures and strict vigilant oversight mechanisms. Without these foundational elements, the plan risks not only failing to achieve its goals, but also precipitating a crisis of confidence and financial stability that could set the European project back for years to come. The stakes are extraordinarily high, and the margin for error is vanishingly small.